What's going on, everybody? This is George with Win Your Wealth. Thank you guys so much for watching this video. And today we're going to be talking about a really interesting topic. And that topic is, why do passive investors beat day traders? But before we get into it, I just wanted to let you guys know about something that not many people know about. If you look down there, there's a thumbs up button and it's white and it's really lonely. And deep down, that like button wants to turn blue. So if you can just go down there and click it, I would highly appreciate it. But in all seriousness, guys, I wanted to talk about this because if you guys haven't noticed already, if you guys are on social media or YouTube or Instagram, and you have any interest in personal finance at all, it's very likely that you've probably run across some of these online gurus. These guys are out there trying to sell you a dream that you can make a killing day trading. Some of them even go as far as to do live streamings on Facebook or YouTube just to show you that they're legit. But at the end of the day, these guys, all they're trying to do is trying to sell you a course. And when you really look into it, that's actually how they make a majority of their money, by selling you courses, not by actually day trading. And I wanted to do my part on this channel by making sure that I presented all the facts. So let's go ahead and get into it. All right, first of all, what is a passive investor? A passive investor can be defined as somebody who constantly invests into the market no matter what's going on. These types of investors often adopt what's called a buy and hold strategy. So regardless of whether the market is going up or going down, they're usually taking advantage of something called dollar cost averaging, meaning that every week or every month, whatever period it be, they are investing the same amount of money into their investments every single month. These guys aren't constantly worried about what a stock or what the stock market as a whole does on a day-to-day, weekly, monthly, or even yearly basis. These guys have a long-term outlook on their investments. Passive investors are also not trying to figure out which are the winning stocks, but rather they look into the market as a whole and they buy into very simple passive investments like index funds or ETFs. They also don't do anything complicated. They don't engage into things like margin trading, day trading, commodities, or forex trading. None of that stuff exists in the vocabulary of a passive investor. And probably the most important characteristic of these type of investors is that they're not looking to try to make a quick buck. They're trying to actually build wealth over a long period of time. It is the safe and most guaranteed way to become wealthy. Day traders, on the other hand, are pretty much the polar opposite of what a passive investor stands for. These guys are pretty much trying to make money so they can live on. So a day trader's goal is to take advantage of very short-term market fluctuations. So all the investments that they buy in very short time frames, usually within just a couple of hours, but on occasion they'll also do 2-day, 3-day trades, which is also called swing trading. This type of trading is very risky and it requires a lot of skills. You have to be very skilled in technical analysis and chart analysis. This is where you'll often see these gurus try to teach you a little bit about what they know on YouTube, ultimately so that they can sell you a course on how to do this technical analysis. But oftentimes what you're going to find in that course is nothing really that you couldn't have gotten for free. And the reality is that a vast majority of day traders actually lose money. If you just go out there and take a look at some of the research, you're going to find that almost 80 to 90% of active day traders do not make any money. That means that on the best scenario, only 10% of people who try to day trade actually make some kind of money. Now, out of that 10%, I imagine that only a very small portion of that percent actually makes a livable income. Now let's talk about why that is. So why is day trading risky? I believe that it all comes down to two things. First, as opposed to a passive investor who invests in things like ETFs and index funds, which is pretty much a large basket of diversified stocks, a day trader instead tries to find a couple of companies within those to place very short-term bets on. Now, the general rule of thumb is that the more companies that you buy into, the less risk there is for the investor. So is it better to have all of your eggs in one basket or to have your eggs spread across multiple baskets? The active investor is essentially doing speculation, where he believes that if he puts all his eggs in this one basket, all of a sudden that basket is going to grow and multiply. For example, the S&P 500 is an index of the top 500 companies in America. If you have an index fund or ETFs in an S&P 500 fund, you are spreading your money across all of these 500 funds. Active day traders will trade typically anywhere from 1 to 5 or 10 stocks a day. with the intention of buying in quickly and selling quickly to make a quick profit. The problem multiplies itself because of this very short time frame as well. While the passive investor is okay with making a smaller return, something like 7 to 10%, the active trader is trying to look at making anywhere from 1 to 2% per day. And as I mentioned earlier, 90% of all active day traders can't even break even. Active traders also have to pick up a very unique set of skills in technical analysis. And the truth is that a lot of people try to actually begin learning the basis of technical analysis, and very few of them actually end up mastering the art. All the while, they're paying hundreds, if not thousands of dollars in order to learn this from somebody else. Because these active traders are looking to make an income, they are using what are called taxable accounts, meaning that even if they make money on an investment, they are going to be subject to taxes on these gains. That is not to mention all of the fees that they're going to have to incur from doing these trades. Now, I'll readily admit that nowadays that might not even be a problem because of places like Robinhood or Webull that offer free trades. But I know a couple of people who've been day traders in the past, and they opt to using more expensive software or brokerages in order to get just a little bit more of an edge. Now, the worst thing that can happen to a gambler is that they win the first time they go gamble. I don't know if this has ever happened to you guys, but if you've ever gone to the casino and beat them, your immediate urge is that you can win. There's something special about the way you play blackjack or roulette or whatever your game is. So maybe next week or next month you go back to the casino and you find out that you weren't so special after all. You end up losing a lot of the gains that you had made that time you'd gone to gamble prior. And that is really what happens to a lot of these day traders. They try it with a little bit of money and they end up making a little bit of money, and they mistakenly believe that instead of it just being luck, they believe that they actually have some kind of gift to do this. So they go in next time with more money and maybe they win again, but eventually they will lose. Or at least I should say that the odds are that they will at some point lose. This is better known as the gambler's fallacy. And ultimately, it causes these day traders to start investing with emotion, as opposed to a passive investor who doesn't take emotion into it at all. Most passive investors have actually automated a lot of their investing. A lot of them don't even have to go into their brokerage account to invest. It's usually automatically drawn and invested for them automatically. And this completely removes the emotion away from investing and ultimately allows them to be able to build wealth over time without being emotionally invested. Because the problem is that if there is some kind of market issue or a market downturn, an emotional investor will want to pull out their money, when actually the right thing to do may actually be to invest more money right now that the market is down to take advantage of the upswing. The easiest way to do this without thinking is doing dollar cost averaging, just putting a little bit of money each month no matter what. These passive investors also put their money into these tax advantage accounts like IRAs and 401ks. As a result, all that money grows either tax-free if it's a Roth, or you take advantage of the tax break right up front. These accounts also have limitations where you can't actually take the money out without penalty until 59.5. And as a result, this allows a passive investor to leave his money alone and allow it to grow over time. And the last thing that I want to discuss is actually go through a very simple example of how it's actually very difficult to do this, especially if you only have a very small amount of money to invest in day trading. In this example, let's just say that you have maybe $5,000 that you have as extra cash in order to day trade and make a side income. And let's make the assumption that you've gone through all of this course training, you are just super gifted at what you do in day trading, and you're gonna make 20% return that first year day trading. Now, as I mentioned earlier, the average rate of return in the market is anywhere from 7 to 10%. So if you're making 20% a year on your money, then you are actually doing at least twice as good as the market. Now keep in mind, this is a very far-stretched example because like I mentioned earlier, 90% of day traders don't make money at all. So you gotta assume that you're really, really good at what you do here. So let's go ahead and take those numbers and let's see what you actually made. Well, if you made 20% of $5,000, that's $1,000. Congratulations, you've made $1,000 in 1 year. Now remember, day trading is something that you have to do actively. Most day traders have to wake up early in the morning in order for them to take a look at the market, figure out which stocks that they want to add to their watch list, take a look at the chart analysis, and ultimately make a decision on whether they want to buy or sell. They also usually have to do the same thing in the afternoon before the market closes, so they can go ahead and sell some of the investments that they made earlier in the morning. So let's just be very conservative here and say that the active investor only works about 2 hours a day, Monday through Friday. Hell, let's even make the assumption that this guy takes off a whole month of work. So he doesn't work for 4 weeks. So that's 48 weeks a year where you work 5 days every single week. And every day you work for 2 hours. So that means that every week you're gonna work 10 hours. So for 48 weeks, that's 480 hours that you will work in day trading all year. So let's take that $1,000 and divide it by 480 to get exactly how much you made per hour working as a day trader. So 1,000 divided by 480, that's about $2.08 an hour. You can go out and work at McDonald's part-time and make 4 or 5 times more than this day trader. So the point here is that if you don't have a lot of money, you really won't be able to make a whole lot of money day trading to begin with. You tend to also take a large amount of risk because you see all these people with a bunch of money making these big purchases. You then decide that you want to go out there and take a margin trade, or you want to get involved in using debt. And this is how you end up going bust, or even end up being in debt to people. You might end up engaging in margin with your brokerage firm and end up owing them hundreds of thousands of dollars. This is not something that I would recommend when you have a very good, stable option of passive investing. If you were going to take the passive investing route, let's just take that $5,000 and instead of day trading, just put it into a very simple index fund. If you make 8% a year for the next 40 years, so let's just say that you're 25 years old and you take out that money when you're 65, if you don't even add one single penny, that $5,000 initial investment will turn into over $120,000 just with that one-time investment, never adding a single dollar ever again. And that's making the assumption that the market only returns 8%, which is actually kind of a conservative number for that long of a period. All right, guys, so that is the reason why passive investors beat active day traders. If you guys have any questions, be sure to leave them in the comment section below. And once again, hit that like button and make it turn blue. Take care, guys, and have a great one. See you later.